In the waning days of 2017, the aisles of the world's most famous toy empire were quietly bleeding out. Millions of consumers assumed the culprit was obvious, believing a digital behemoth named Amazon had simply rendered the physical toy store obsolete. Yet, the true autopsy of this retail giant reveals a far more insidious cause of death: the collapse of Toys R Us, an institution that once controlled a quarter of the global toy market, was not merely a casualty of changing consumer habits. It was a masterclass in wealth extraction, a stark demonstration of how complex financial engineering can hollow out an empire from the inside long before the final customer walks out the door. The foundations of this empire were built on an unprecedented retail philosophy known as the category killer. Decades before the digital age, founder Charles Lazarus applied the high-volume, low-margin logic of the supermarket to children's entertainment, creating massive warehouses stocked to the ceiling. This sheer scale allowed the brand to dictate terms to manufacturers, crushing independent shops and department stores alike. For a generation, this dominance felt unshakable, cementing a cultural and economic monopoly that seemed immune to the standard cyclical downturns of the broader retail sector. But the armor of that early market monopoly began to fracture at the turn of the millennium. A new breed of big-box retailer, led by Walmart, began utilizing toys as loss leaders. By slashing prices on popular action figures and board games below wholesale cost, Walmart lured parents into their stores to buy higher-margin groceries and household goods. The category killer suddenly found itself outmaneuvered by a competitor willing to bleed money in the toy aisle to win the entire shopping cart. Facing this relentless price war, the legacy toy retailer made a fateful compounding error in its digital strategy. In the year 2000, rather than building its own e-commerce infrastructure, the company signed a 10-year exclusive partnership with a burgeoning online bookseller named Amazon. By outsourcing its digital storefront, the toy giant effectively handed over its customer data, its online brand identity, and its future to a platform that was rapidly transforming into its most lethal competitor. The echoes of that outsourced digital strategy would haunt the boardroom for a decade. When the partnership inevitably soured and ended in litigation, the toy retailer was left stranded in the digital dark age, years behind in logistics, web design, and customer fulfillment. Yet despite these structural vulnerabilities, the company still possessed massive cash flow, prime real estate, and unparalleled brand recognition. It was this lingering, cash-generating potential that attracted the gaze of Wall Street's most aggressive predators. In 2005, a consortium of private equity titans executed a monumental takeover. Bain Capital, KKR, and the real estate investment trust Vornado pooled their resources to take the public company private in a $6.6 billion transaction. This was not a rescue mission designed to modernize a struggling brand. It was a classic leveraged buyout, a financial mechanism where the acquiring firms use a massive amount of borrowed money to fund the purchase, then legally transfer that debt onto the balance sheet of the target company itself. Suddenly, the very asset being acquired was forced to pay for its own capture. The private equity consortium contributed only $1.3 billion of their own capital, saddling Toys R Us with over $5.3 billion in new high-interest debt. Almost overnight, a retail operation that had historically carried minimal liabilities was transformed into a highly leveraged entity. The financial architecture of the business was completely rewired, prioritizing debt service above all other operational imperatives. This crushing financial burden fundamentally altered the company's trajectory. Before the leveraged buyout, the retailer generated robust operating profits that could have been deployed to revamp decaying stores, build a proprietary e-commerce network, or lower prices to compete with Walmart. Instead, a staggering $400 million a year was instantly vaporized just to pay the interest on the debt. The capital required to survive the retail apocalypse was being systematically funneled to creditors in Manhattan. The physical manifestation of this capital drain became impossible to hide from consumers. While competitors invested billions in bright, interactive store layouts and seamless mobile applications, the legacy toy warehouses remained trapped in the 1990s. Aisles grew cluttered, facilities aged, and the magical customer experience that originally defined the brand deteriorated into a frustrating, neglected chore. The company was starving, denied the vital nutrients of capital investment while fighting a two-front war against big-box discounters and digital giants. Even as the store experience decayed and market share eroded, the financial engineers behind the curtain continued to extract wealth. Bain Capital, KKR, and Vornado charged the struggling retailer millions of dollars annually in advisory fees. These payments were extracted for management services, ensuring that the private equity sponsors profited reliably year after year, entirely insulated from the operational rot spreading through the actual retail locations. The incentives of the owners were completely decoupled from the long-term survival of the business. The fragile equilibrium created by this financial engineering could only persist in a perfectly stable economic environment, but the retail sector is notoriously volatile, heavily dependent on the crucial fourth-quarter holiday season. By 2017, the structural rot had reached a critical threshold. A minor dip in sales growth triggered panic among the company's global network of suppliers. Fearing they would not be paid for their holiday shipments, these vendors abruptly tightened credit terms, demanding cash on delivery. This sudden liquidity crisis was the fatal blow for an entity carrying over $5 billion in debt. Unable to secure the inventory required for its most important sales quarter, the company was forced to file for Chapter 11 bankruptcy protection. Initially, leadership promised a swift reorganization, aiming to shed debt and emerge leaner. But the sheer complexity of the leveraged capital structure, combined with the unforgiving realities of the modern retail landscape, made a clean restructuring mathematically impossible. The illusion of a turnaround evaporated entirely in early 2018. Creditors, realizing the decaying assets were worth more dead than alive, forced the complete liquidation of the United States operations. The closing of over 700 stores sent shockwaves through the commercial real estate market, leaving cavernous, empty shells in shopping plazas across the country. A cultural touchstone had been systematically dismantled, entirely erased from the physical landscape by the cold calculus of its debt obligations. The human toll of this liquidation exposed the brutal asymmetry of the leveraged buyout model. Over 33,000 retail employees, many with decades of loyal service, were suddenly terminated without severance pay. The bankruptcy code prioritized secured creditors and administrative fees, leaving the workers at the bottom of the capital hierarchy. The architects of the buyout had legally shielded their core funds, while the workforce absorbed the absolute devastation of the collapse. The fallout from this massive job loss sparked unprecedented outrage and a rare moment of worker mobilization. Former employees organized, protested, and directly confronted the private equity sponsors, demanding accountability for the wealth extraction that had destroyed their livelihoods. This public pressure eventually forced Bain Capital and KKR to establish a $20 million hardship fund. Yet, this concession amounted to a fraction of the advisory fees the firms had extracted during their tenure, a mere rounding error in the grand ledger of institutional finance. Looking back at the rubble of this retail empire, the narrative that e-commerce alone killed the physical toy store falls apart entirely. Amazon merely provided the competitive pressure, but the fatal wounds were entirely self-inflicted by financial architecture. If Toys R Us had not been suffocated by billions of dollars in debt, it would have possessed the financial agility to pivot, to innovate, and to survive the digital transition. Instead, it was treated not as a business to be grown, but as a host to be drained. The downfall of this iconic brand stands as a permanent warning about the hidden gears of global commerce. It reveals how the abstract mechanisms of private equity can reshape the physical world, turning beloved institutions into collateral damage in the pursuit of yield. The true danger to a corporate giant rarely comes from a competitor with a better product. It comes from the boardroom, where the relentless demand for short-term financial extraction inevitably devours the very foundation of long-term survival.